The Great Depression would come to be remembered as a deep crisis that shook the world economy for nearly a decade, beginning in 1929. It was a historical rupture that fundamentally questioned the functioning of the modern world. Industrialized countries were the most affected by this period. Production collapsed, unemployment rose rapidly, and deflation became a global problem. In the United States in particular, this period fundamentally altered not only economic structures, but also the core assumptions about the role of the state in the economy. By the late 1920s, the United States was experiencing one of the strongest economic periods since its founding. Production was increasing, cities were expanding, and consumption was accelerating. This state of prosperity gave people the impression that not only wealth, but also stability was permanent. On the surface, the existing economic system appeared to be functioning. However, this condition was not felt in the same way at every level of the system. Some fragilities were silent. And silent fragilities are often the most dangerous. With the end of the First World War, America had become the center of the global economy. Industrial production increased, and automobiles and electrical household appliances became widespread. This growth was not related only to production. Credit had become a natural part of everyday life. People were spending with the belief that they would earn money in the future, and companies were treating growth as almost uninterrupted. Prosperity had turned into something increasingly difficult to measure. Living by expectation was the first sign of a great disaster. The stock market was the most visible part of this expectation. Stocks had become not only investment instruments, but also social symbols for people. Many investors were purchasing stocks with borrowed money. The leveraged system could turn small fluctuations into large gains. But the same mechanism also worked in the opposite direction. When prices fell, debts remained in place. At this point, the system was relying on a balance built on optimism. And this balance was fragile. In the autumn of 1929, the stock market collapsed. However, the collapse of the stock market could not be the story of a single day. Prices fell, panic began to spread, and sales increased. In the markets, a self-reinforcing collapse began. This collapse did not affect only investors. The stock market was linked to banks, and banks were in turn linked to the real economy. This rupture within the financial system turned into a shock that spread throughout society and proved difficult to reverse. Over time, banks began to fail. Depositors rushed to bank branches to withdraw their money. In many banks, money technically still existed, but investors no longer had trust. The financial system did not consist only of numbers. It was built on people's belief in those numbers. When this belief disappeared, the system began to strain and stopped functioning. As a result of this process, unemployment rose rapidly. Millions of people lost their jobs. In cities, long lines for aid began to form. And people living in rural areas became unable to repay their debts. It would not be accurate to describe this as merely an economic crisis. This was a sign of a social rupture. People were losing not only their incomes and savings, but also their expectations for the future and their hopes. As the crisis deepened over time, the role of the state naturally began to be debated again. The idea that the market would regulate itself had collapsed. During this period, the New Deal came into effect. What was this New Deal? The New Deal was a set of programs, public investments, and fiscal regulations implemented by President Franklin D. Roosevelt between 1933 and 1938 in order to mitigate the effects of the Great Depression and restore stability to the economic system. This approach was based on the belief that the crisis had emerged from the market's own internal dynamics and that state intervention was necessary to rationalize the economy. At this point, the state felt the need to intervene directly in the economy. The banking system was reorganized, public investments increased, and social security mechanisms were established. This initiated a lasting transformation in the American system. Power was no longer located only in the markets. It was increasingly taking shape within institutional structures. The Great Depression led to a permanent change in America's economic model. Financial oversight mechanisms were strengthened. The state's responsibility in economic matters was redefined. At the same time, this experience became a reference point for global crises that would occur in the future. The system did not collapse completely, but it could not continue in the same way, and a new direction was set. Did the Great Depression weaken America? Or did it transform the country into a more resilient power than before? This question is not only about the past. Modern economic systems are still built on similar assumptions. In the United States, this period was remembered as the most severe social and economic trial since the American Civil War. And ultimately, every system is tested repeatedly. As systems prepare for their next trials, they internalize their previous fractures within them and draw lessons from them. This transformation would lay the groundwork, a few years later, for a new test of power on a global scale: the war economy and the Second World War. To be continued in the next video.